Hi everyone, on this installment of Take Charge Now, I thought I would focus in on the markets and your money. You know, if there's one word to describe the past year, it's been volatile. There's no question about it. There has been nowhere to hide. Sure, I guess you could have gone into the US dollar or US treasuries, but how many of us really did that? I did not. However, it's been a tough time, but that doesn't mean you have to compound it by some of the harmful things that I'm also seeing people do when it comes to their portfolios. I thought I would highlight just a few for you. The first is not paying attention to your asset allocation. Now, at a very basic level, asset allocation is how much money you have invested in cash, fixed income, such as bonds or guaranteed investment certificates, and the stock market. If you're a 50-50 investor, a balanced, you have money in the stock market and bonds. I can tell you our asset allocation, we have about 60% in stocks, about 30% in fixed income, and 10% in cash. We have some cash because we want to make sure we have money for buying opportunities, but living expenses, etc. So that's my asset allocation, but that really doesn't matter. What truly only matters to you right now is what your asset allocation is. What makes diversification work is your asset allocation. When we talk about having a diversified portfolio, you don't want all of your eggs in one basket. You don't want all of your money invested in one company, one sector, one currency, one country. You get where I'm coming from. But what it really also comes down to, how you spread your money across cash, fixed income, and the stock market is your tolerance for risk. And we're all different. The number of direct messages I've received on Instagram focus in on losing money. Will these markets come back? You're not sleeping at night. And if you're not sleeping at night, you likely have more risk in your portfolio than you should. And when the markets are going higher and higher and higher, we often have a higher tolerance for risk. When the markets go down, 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 all of a sudden that tolerance isn't there to the extent that we thought. Ask yourself two questions. How much money am I willing to lose? And how much money can I afford to lose? Something we often think about in our household is that we need at least a 5-year time horizon when we buy good quality stocks that are leaders in their industry, have real cash in the bank, and they pay a dividend. That 5-year time horizon and those dividends, they pay you to wait. So something to think about. Also think about not believing your own predictive power. You may be a novice first-time investor, and you may have got it right going into a particular stock and made or had, shall I say, a big win. That's great. But the fact is, it might not happen again. And it certainly might not happen to the same extent. And not only do you have to get it right buying in the first time, but when you get out, you have to get it right. And then maybe when you go back in again, don't believe your own predictive powers. I'm more in the camp of dollar cost averaging. Having a fixed amount come out on a regular basis, going into your asset allocation, fixed income in our case, as well as the stock market, but keeping some money in cash. It takes the guesswork and the emotion out of investing. The next element that I see people do all the time is they don't have a plan, or they say they self-eliminate. I don't have enough money, so I don't deserve to have a plan. Yes, you do. Every person has a financial goal that matters to them, that will change their behavior. When you have financial goals and you have a financial plan and you have the financial maturity to stick to that plan, you will start to see things happen. It's not about one big thing happening. It'll be about a lot of little things that start to add up, and then you start to gain some traction. But here's the thing. Your plan is not carved in stone. Life could throw you a curveball when you least expect it, a financial detour. If you have a plan, you can take corrective action and you can see how to go about doing it. If you don't have a plan or a financial destination, how do you know if you ever achieve your financial goals? And the last one that I really want to highlight today is adopting that herd mentality. If everybody's doing it, I should do it too. No, you shouldn't. If everybody throws in the towel and capitulates and moves to the sideline and yet you have good quality investments, a reasonable time horizon, great asset allocation, I'm not so sure you should. Maybe the hardest thing for you to do right now is to stick it through. Stick it out. Just stay invested. Here's an example I'm going to leave you with. If you were invested $10,000 in the S&P TSX for a 30-year period and you left that money alone, just left it from December 31st, 1991 through December 31st, 2021, that $10,000 would be worth over $60,400. If you miss just 1% of the best trading days throughout that period, you would be left with your $10,000 investment, $3,700. And here are just a few of the reasons why you might have moved out of the market. The Asian financial crisis, the dot-com bust, 9/11, the global financial crisis of 2008, China's stock market crash in 2015, COVID, the list goes on and on. You get where I'm coming from. We can't control the market, but we can control our behavior. As I've said before, I've been through a lot, ups and downs in this market. I do believe things will come back, but we don't have to compound the volatility in the markets by the behavior that we undertake with our own money.